Right. Thanks very much, Cameron. Good morning, everyone, and hi to Neville and Clyde. So what was I thinking about when you only have one slide? To me, the big thing that's going to change is eventually the news and the fear of the pandemic is going to subside, and the focus is going to move away from the virus to the economic costs of the global lockdown. But that's also fairly well known in the short term. But I think the focus in a couple of months is really going to be on who's going to pay for it. So if we look at the massive fiscal spending and expansion of central bank balance sheets, even Germany is abandoning sort of conservative financing. And if we look at the numbers from the UK and the US, I mean, it wouldn't be out of line with Zimbabwe. So for example, the Federal Reserve last week committed to buy at least $120 billion of debt per month. Now, people are just so used to big numbers. If I put that into context, you can buy the whole of Richmond plus British American Tobacco every month. Right? So these numbers are just staggering, and it's occurring at the same time as when many of the world's population in the Western world are starting to, I guess, lean towards the left in terms of voting. So if we just look at the slide here, I try to find one way to show it. This is from Deutsche Bank, and it looks at the US and major European economies, and it looks at the biggest bailouts over history in today's money. So the bars are really the amount in trillions, and the right is the red line that shows the debt of the 7 biggest countries relative to their GDP. And this is a month out of date, by the way, which makes a big difference. But you can just see the bailout so far is just massive compared to anything in history. We spent more money in the last 2 months than we did to the whole GFC. And I just put an interesting quote there from Merrill Lynch, which I quite like. People saying, well, how can the stock market be going up when the economy is so bad? And often the stock market leads the economy. But in this case, it's very interesting. Most people would say long bond yields are manipulated. They're not a true reflection of market prices. So why would you expect shares to be any different over the short term? And while this is very frustrating for value investors and for people who think a lot about bottom-up fundamentals, we're thinking hard about the portfolio and how we put it together in a diversified portfolio of undervalued assets. Cameron, if you just go to the next slide. So when I think about you all see the fact sheet, so there's nothing new here. But to me, it's very interesting that I think the local asset management industry, in my own view, is very extremely positioned. And what I mean by that, I don't remember everyone being positioned so similarly other than maybe 2001, maybe the end of 2008. If you look through the fact sheets, almost everyone owns the big dual-listed businesses, whether it's Naspers and the others. They all just hold them in different weightings. Everyone owns 100% of their offshore exposure in equity, generally in sort of growth, pharmaceutical, food-type stocks. And then to deal with Reg 28, you have a massive hedge back by going along the South African government bonds. Now, all of those things make sense to me, and it's kind of a little bit of how we position, but I guess the contrarian in me starts to get a little bit excited when I see sort of everyone positioned the same way. And what really interested me was 2 weeks ago when we had just the first sort of indication of people maybe moving a little bit the other way, where you have to buy some more domestic stocks or perhaps sell some government bonds. We had a very violent move in the South African market. Some of the shares were up well over 100% over the week. So I do think everyone is very similarly positioned. I do think it's a logical positioning, but it is something that concerns me a bit. So if you just look at our asset allocation there, not too much has changed. We're sitting in the low 60s. We did bring money back physically to South Africa in February and March to buy government bonds. I think Allan Gray as a whole bought about 7 billion rand of long bonds during that dislocation. But we think the portfolio is reasonably well positioned at the moment. I guess the one difference we have with the other two presenters is Africa. Believe it or not, Africa actually held up quite well when measured in rands. Sorry, Cameron, my last slide. Yeah. And then, the top 10, as I mentioned, we're trying very hard. We think there are a lot of very depressed South African shares. I know they're small in the portfolio, but if you have a look, the casino shares are up 50% today because we opened, something like Nedbank, I think worth probably twice the current share price, but we do know all the risks that are there in our local economy and the way our government might manage the exit plan. So, we also have a big exposure to the dual listed. Probably Glencore is a bit different from the BHP and Anglos that most people own, and then we own a collection of undervalued South African shares. For me, the biggest differentiator we have is the Orbis portion of the portfolio. So the Orbis portfolio looks very different from most of our competitors' offerings. If you ask me where does our relative performance, that's where I think most of our relative performance can come from. So I think I'll leave it over there and I'll hand over to Clyde.
Thanks very much, Duncan.
Yes.
Yeah, good morning. Good morning, everybody. So just in terms of thoughts, I mean, I think Duncan has already sort of perhaps said some of the things that I wanted to say. So I'm not going to talk about the things where we have essentially consensus views. Let's talk a little bit about where we perhaps different on that front. Now, firstly, if you look at the environment, I think where we do perhaps disagree is that the liquidity was unfortunately necessary in order to stave off probably what would have been a particularly bad crisis. Now, the liquidity has been concentrated in the Western world, which means that liquidity has found its way into a narrow pot of assets, which have some clear advantages over many other businesses out there. And I don't think it's for no reason that the liquidity has gone into narrow parts of the market. I think one of the big questions that is up for debate is whether there will be big shifts into areas which have been certainly unloved and underappreciated in the opinions of many. And that's a topic we can come back to. But I think for us, I mean, the key points thinking about this going forward is there's no doubt that there's a recovery underway. The speed of the recovery, the trajectory is going to be a function ultimately of government policy. And I think here's one key differentiating point. We do think that things will revert to the trends that were in place before COVID. COVID is not a trend changer. COVID is a trend reinforcer. And what we mean by that is if you think about an obvious one is people moving to more and more online purchases. I mean, that trend was in place before and it's just been accelerated through lockdown. So if a business has been on the wrong side of that trend, it's not suddenly going to find a growth trajectory and growth curve in order to bail itself out or to help it along its way. And I think that's quite an important consideration that needs to be applied across portfolios and across quite a large number of holdings and countries as well. If you sort of think about where South Africa's positioned on that basis, I mean, one of our concerns would be that South Africa certainly is not well positioned in terms of being a massive twin deficit country. We're going to borrow extraordinarily large amounts of money, which we can't fund at zero cost, and that's going to have significant implications for the marketplace down the line. And I think one of the things that's quite clear to us is that we think government policy in South Africa is unfortunately geared towards fostering or continue to foster weak GDP growth, unnecessarily weak currency. The policy is incoherent, and interest rates are still too high in real terms. And the reason why that's so important is because when you think about the bond market, which everyone sort of poo-poos at times as being the sort of asset class that no one really understands and is linked to the currency and is owned by foreigners. I mean, ultimately, the bond market is the cost of capital for South Africa, which represents an extraordinarily important hurdle rate where capital allocation decisions are made by many companies across the board. And the fact that bond yields are still, well north of 10%, despite having rallied materially, it is extremely important to consider. Clearly, there are huge tail risks around South African government and investing in the bond market, which again we can talk to. So if you think about exposure in our portfolios, we've had perhaps more bonds than many of our peers and competitors, and not because we have a differential view around the poor productivity indicators. We're all worried about the same things, contingent liabilities of SOEs. That's not the issue. The issue here is that until the bond market gives us a low cost of capital and something that many companies can with confidence invest to produce high returns, there's no point, we think, in terms of investing in other assets. And that's why we've had a materially low exposure to local assets, particularly on the equity side. And if you look at our positioning now, we think it's still relevant that positioning should be in place even where we are today. So that's the way our differential exposures are around much higher global equities. And then in South Africa, it's been a concentration in South African fixed income assets over SA equities. And even within the SA equity sleeve, which is 23%, if you look at the pie chart, there is a bit of a skew. Now, I agree that with Duncan that perhaps the less interesting allocations are Naspers and BAT, which are owned by most managers. But outside of that, I mean, if you look at some of the exposures we have, there's very little overlap between our portfolios and both Coronation and Allan Gray. And we did a quick calculation, not that we have full insight to the bottom-up analysis, but we think that there's probably only about an 18 to 22% overlap in terms of having similar holdings from what we can see from publicly available fact sheet information. So we think that's quite important, because that means that there will be materially different performance numbers coming from the different strategies over time. And then just lastly, on the top 10 of our deck, I think maybe again the differentiator here is the very strong representation that some of the best businesses in the planet have expression in our portfolio. So you will see a significant exposures on a see-through basis to South African clients of Visa, Microsoft, Moody's. These are businesses that are just world class and have structural growth opportunities over many years. And I think that's quite important, that when South African thinks about the role that equities play, equities should provide one with multi-year growth. And it's not obvious to us that many South African businesses can provide one with multi-year growth. And that's unfortunately necessary if you're wanting to compound clients' wealth. I'll stop there, and I'll hand over to Neville.
Thanks, Clyde. Yeah, again, there's going to be a lot of similarities. I think, following on from what Duncan was saying earlier, I mean, there are massive contrasting forces in the world. This battle between a global recession, which has been brought about by the lockdown, and at the same time, this unprecedented monetary stimulus. Just the frightening numbers. We've all become immune to talking about trillions of dollars, which is just a staggering amount of money. One of the key factors that makes this incredibly difficult to call at the moment is the fact a fiscal crisis, a monetary crisis, a banking crisis. You generally know the solution. The issue here with the medical crisis and the behavior and response to it is just actually, when do we actually come out of this? What is the resolution? What actually gets people feeling comfortable to spend again? Is there a second wave? Do we actually only move back towards a more normal environment when there's actually an actual medical solution? As Duncan alluded to, a lot of the stimulus has really been taking place in the developed markets, and emerging markets in particular, given the nature of their balance sheets and how they've entered this, have come in, with much less ability to provide the level of stimulus that we've seen from developed markets. Meaning outside of Asia, a lot of EMs are really in a very difficult position. The lockdown, and we've seen it around the world. We've seen lots of debate around it. We could probably spend an hour discussing the rights or wrongs of it. But particularly in South Africa's context, has been immensely damaging. And I think, we still, or certainly government, and I think a lot of people still haven't quite grasped just how damaging and how long we're going to be feeling the after effects of the lockdown in SA. And even in this environment, just thinking domestically, and this does impact our thinking around a lot of asset classes, is despite the crisis, we still seem to be floundering. We still in a, to use a silly but valid local example, in a world where the most profitable airlines in the world have failed, we still persist in trying to fund the world's worst airline. So, I mean, we just continue to see the wrong policy choices made in SA. So, moving into that second column, the impact on assets, I think it's consensus that global bonds, are offering very poor value, the mispricing. There was a very, very brief period during the midst of the crisis where suddenly credit became quite attractive, but that was shut out by the Fed, where we see, the announcements that they've made and started last week actually buying sub-investment grade bonds. And that's really squeezed out what few opportunities there were in the global credit market as well. Global equity, similarly, a crazy period where very cheap for about a week. And since then, we've seen those markets rally incredibly strongly. I've discovered the joys of something called Robinhood and Davy Day Trader. There's just, Duncan was talking about the casinos. A lot of people seem to have just moved from the casinos into the stock markets, and you're seeing some incredible behavior, being taken in terms of bidding up asset prices in global markets. Domestically, the stocks in SA have looked cheap, but I'm sure we'll touch on it later on. but we are very wary about the domestic stocks. We again think that the economic impact of this lockdown is going to take a very, very severe toll, and that toll will be felt across sectors, because every company today that is cutting costs, which is a euphemism for cutting heads, those people that are losing their jobs are clients of every other company in South Africa. And we think there's going to be very significant second, third round effects. The one benefit, and I'm sure there'll be a lot of mud being thrown at SA today, but the one thing we can be proud of is the fact that we do have a floating currency which does absorb a lot of the shocks. And in fact, in the short term, we think, South Africa probably absorbs shocks from the rest of the world. It's a liquid market. We tend to sell off more aggressively than the rest. But we do think in the short term that can strengthen. And then lastly, it hasn't been discussed, but listed property, again, it's almost the center of the storm. You're seeing effects, whether it's retail centers and people not being allowed to shop, whether it's offices and work from home. Clearly massive effects on the property sector. And that's something that one needs to think very carefully around in the asset allocation. And lastly, just cash rates in SA. And this is a very, very important point when you talk about some of the questions later on. For the last few years, we know in South Africa that a lot of people have been hiding in the comfort of, the cash plus kind of funds. Coronation itself, Strat Income's been, one of the most successful funds. The reason being that you've been able to achieve, on a pre-tax basis anyway, returns ahead of inflation without major risks. But the reality is, going forward, with interest rates now around 3.5%, maybe even going to be going lower, the opportunity or the protection that you think you're getting there, it's not going to be there anymore, and one is going to have to look at riskier asset classes, which we think do offer more upside now. So we are positioned, if you move on to the next slide, with quite a high weighting towards risk assets. And again, one can spend a lot of time talking around what Duncan was saying around, what's being mispriced. The reality is, if the world's taken the view of printing money, cash is going to be, one of the worst asset classes to be exposed to. You do need to look for real assets. We do have a reasonably high weighting to equity. We did take the opportunity during the crisis to upweight our international equity. We think that, given the fact that developed markets are going to be able to support and stimulate their economies better than international equity, was a better place to be. But at the same time, we took the opportunity to reduce the currency exposure by hedging some of those dollars back into rands. If you move on to the next slide, just the top 10 positions within the fund. A key differentiator as well, we believe, was when we were buying SA assets, is looking for quality. We want to own the top quality assets, those that are really, incredibly well positioned, either from a balance sheet position or in terms of their business model coming out of this. This is not a time or an opportunity where one wants to be dabbling in the more speculative businesses. We just think the risks in the economy are such that you want to focus on quality, and that we really have taken an opportunity to increase what we think are some of the higher quality names listed on the JSE. So the last slide.
Okay.
Okay.
Right, thanks very much, everyone. Okay, so what I want to do is I want to start off with a question that I'm actually going to ask all three presenters to answer, and I'm going to reverse the order, and I'm going to ask Neville first. And a lot of the questions that we've been getting over the past few weeks and months refers to this concept of the new normal. And I think it's always tempting whenever we see a market crash to think that this time is different. So I guess the question I really want to ask all three of you is this time really different? Are you thinking about your portfolio positioning, and more importantly, the process of how you construct portfolios differently this crisis relative to previous periods. And just one additional point, if you haven't spoken about, what changes you've made over the past couple of months, then perhaps incorporate that into your answer. So Neville, I'm going to start with you.
Thanks, Tamarin. I think every crisis is different to some extent, and the way the market reacts and responds to it's different. If you look back at the financial crisis, the markets troughed and then stayed low for about 6 months and then recovered quite quickly, which surprised everyone. This crisis, the markets troughed and they bounced back within a couple of weeks. And at the same time, we're now looking at levels of stimulus, levels of fiscal easing, which we've never heard of before. So, the certainty, and then the very nature of the crisis, the fact that it was driven by, the panic or reaction to a medical a virus, that's very, very different to your understanding of how things are going to play out in post the financial crisis. And this is one of the reasons why we are concerned about inflation. So after the financial crisis, the banks were broken globally, and they spent the next 5 or 6 years de-gearing, healing, which meant that they weren't extending significant amounts of credit. This time around, the banks are fine. Banks are well capitalized globally. And so we do see that there's a significant risk that the massive amounts of money that are being pushed into economies around the world, you will see a greater, higher velocity of money, which ultimately is going to be inflation. So, following on from that, we are, as I said earlier, we certainly think, global bonds offer no value, and we certainly think cash is not a place where one wants to be, just given the financial repression that's going to take place. One of the quandaries is there's so many of these massive moving forces because, Duncan alluded to it, is someone's going to have to pay for this. And how are we going to pay for this? And there's really there's only two options. Either taxes are going to have to go up, either corporate taxes, which potentially has an impact on equity valuations, or individual taxes, which obviously has an effect on economic growth, or there's going to be massive inflation where global central banks have to inflate away the value of that debt in order to repay it, which has significant implications as well. So, and again, there's not clarity on which one of those options you're going out there for. So you are looking for real protection, which is owning great assets, real assets, equities, and I know there's some questions around it, commodities as well, things like gold in portfolios. Certainly at Coronation, we have a much higher weighting in gold in our multi-asset funds than we've had before. And this is a trend where we are seeing, people looking at physical commodities. But as always, as bottom-up stock pickers, there are always opportunities to identify great businesses which the market's mispricing, either from short-term effects, or they're going to be able to take advantage of some of the new trends that ultimately play out from the environment we find ourselves in. I think, the final point, just to wrap up, was, again, a point I was making is I think you will see a trend back towards the multi-asset funds because there are going to be major, major shifts and trends, which I think the multi-asset funds are really best positioned in order to benefit from going forward.
Great, thanks. Clyde, can you go next?
Yes, thanks. So in terms of different thoughts on portfolio construction, I've had the privilege of living through the late 90s EM meltdown and recovery, the early 2002, 2003 recovery in SA, the GFC and this crisis. And I think what makes this one different from a South African perspective is this is a South African crisis. And I think it's important to state that, whereas if you look at the GFC, the fortunes of many businesses in South Africa were very little changed. I mean, the banks sailed through it with, yes, impairments went up, but it wasn't a South African crisis. Whereas this one, we made decisions that has exacerbated the impact that we've had. And bear in mind that SA, prior to the crisis, was already staring down the barrel of a recession. So there's been no real growth in SA for quite some time. So what's the temptation is to say, well, the crisis has produced extremely weak currency, which it always does. which is similar to the previous occasions, lower stock prices, which is the obvious similarity in all crises produce low stock prices. What's made us a bit more cautious this time around is the fact that we've had to embark on some of the biggest access to foreign financing, and certainly the contingent liabilities and the debts in South Africa are going to be huge going forward, and we still don't really know how those are going to be funded. So therefore it's important not to just narrowly factor in mean reversion in terms of your thought process around a lot of stocks. And the disconnect is that you can't put in nominal growth assumptions for many local businesses which don't approximate something of the long bond yield, whereas we have long bond yields well in excess of nominal growth for quite some time, and that presents one with a huge dilemma in terms of the valuations of many local assets. So to cut a long story short, we've been a little bit more reticent to buy local equities for those reasons. And at the same time, if we look at the shape of the world's economic recovery, there's no doubt that China will lead the economic recovery, although the US is still fundamentally important to drive the stock market's pricing and recovery cycle. And those are two different axes around the same spectrum. So we certainly are more optimistic because the US has a number of really excellent businesses that one can invest in, and China does derive or will generate the economic recovery. Already we've seen, for example, fortunately for South Africa, the fact that the demand for iron ore is still very strong. I mean, most people were looking for iron ore to fall to $60 or $70, and iron ore is at $105 and looking quite strong. So South Africa's recovery trend will be driven by the resource cycle, and there we can have a little bit more confidence in. But outside of that, I think it's important to think through the differences rather than the similarities, and we've certainly taken that into consideration when we structured our portfolios. I would certainly say that in terms of views, I mean, one area that still worries us quite materially is property, listed property, and I know that a lot of stocks there are perhaps call options on a recovery because they're so highly levered and the equity values are so low. But South Africa perhaps has too much retail space across the board, and there has to be a massive consolidation. And it'll be interesting to see how that dynamic plays out. So we've been loath to buy any property, even although the valuations look quite high. The risks have never been higher. And the biggest problem we have is balance sheets. So we see very few high quality cash rich balance sheets, which is why a lot of companies are going to require quite a lot of capital to tide their way through the current environment. And it's not completely illogical that the markets are valuing cash rich, liquidity rich, strong balance sheet businesses higher than ones that do require the kindness of strangers in order to help them through the current environment. And I think that's also quite important to remember in the portfolio construction. We obviously can look at our fact sheets, you can look at the way we've positioned our portfolios for some of the specific details.
Okay, great. Thanks, Clyde. Duncan?
Yeah, so again, it's very similar. I think for me, the big change is if you told me there was no virus and you showed me where the relative share prices were, I would have said I would have been doing exactly what I did during Nenegate, which was selling SAB and British American Tobacco as fast as possible and buying the banks and the local cyclicals, and I haven't done that. So, it's a similar story to Clyde. We're perhaps not as bearish on some of the local stocks. If there's any kind of normalization, and I know it's hard to believe in normalization, but that's why the stocks are where they are. I mean, I think some of them could move a lot. I personally can't think Microsoft can double, but I'm pretty sure Nedbank can. And I know Microsoft's a much better business. So, for us, just trying to get this balance between the big sort of half our South African equity exposure is actually offshore exposure, and then also being able to take advantage of these opportunities. Because when everyone wants to do it, it's going to be too late. It's going to be too late. The shares will start moving. So I think that's one sort of difference. I guess the other thing that was different for us this time, I've been here 20 years, we've always been a low duration house. We've always had low duration, which is why we've tended to do well in down markets when the bonds sell off with equities. And this time, as I mentioned, it's quite different. We actually bought a lot of South African government bonds, and our chairman, Mr. Little, won't be too happy with us for funding the South African government, but what can you do sometimes, I think we're just naturally not bullish on bonds long term, but so we bought a lot there. I guess on the offshore portion, I think we take a slightly different view to Clyde. I mean, obviously he looks at the stocks closer than I do the Orbis stocks, but a lot of the sort of shares that Orbis own, they actually grow in the intrinsic value, whether it's earnings per share or dividends, faster than some of the big sort of global quality stocks, if I can call it that sort of way, which has always interested me quite a bit because I was always pushing them, why don't you own more of these shares? And they'd show us the quant models and say, well, this is what BMW has grown at, and this is what company X, Diageo has grown at or something. And, so to me, also all the sort of numbers I've looked at globally, this is as extreme as you can ever see. It's way past 2 standard deviations for people going for quality versus, I guess, bombed out stocks. And maybe the world is really bad and some of those stocks don't survive, but I think you need to have a mix. I mean, maybe just on property, because I've got shouted at about property for at least 15 years. Everything we were worried about happened in about 1.5 years. And just to share Clyde and Neville's point, it's not easy. You can't just go and buy I suppose you could buy a whole basket and have 1 or 2 that got 3-4 times and 1 or 2 go to 0. But they were massively overgeared. And so I think I'll try to think of anything else, and I think I'll leave it over there, Sam. I don't want to do the other question.
Okay, let me move on to the next question. And I sort of talked a little bit to the comments that all three of you have made around the recovery in equity markets. I think Neville coined it quite nicely. People have turned from casinos into equities. So Clyde, I might start with you, just purely because sort of your net equity position offshore is probably the highest of the three funds. Kind of what's your view on all the questions that have come through, which really point to this sort of almost disbelief between the fundamentals of what we can see on the ground and what we expect to come in terms of bad news leaking out sort of globally and locally over the next couple of months relative to the significant rally that we've seen. I think someone referred to it as the quickest crash ever. So how do you, kind of what's your expectation over the next little while, and how do you sort of square that circle?
Look, I think the first important thing to recognize when you look at the performance of global stocks is to recognize that the leadership is extremely narrow. So the top 7 or 8 stocks in MSCI world have driven 35-40% of the actual returns in the marketplace. And it's fair to say that if you look at the business models of, people have coined FANGs, and then it became FAN-M to include Microsoft instead of Mix, and obviously now you can include even Alibaba and Tencent to a certain extent in the same discussion if you broaden it to MSCI world. The real issue here is that a lot of those businesses are extremely good businesses. I mean, it's hard to argue against the fundamentals of an Amazon or a Microsoft or an Apple. I mean, these are excellent businesses, and they are driving the performance of the market. Now, we don't own many of them because we're not able to underwrite the full investment case across the board, but we understand why they're driving the market. So the first thing is that there's a difference in terms of the performance of stock markets outside of a narrow leadership. And if you look at the performance of those markets, you'll find that more closely approximates people's perceptions around how the economics are evolving. I mean, obviously you can look at the travel space where, many of those stocks are not recovered at all or barely off the floor. I mean, airlines have really been touched on. I mean, some airlines we know have been really hard hit, but I mean, any of the hospitality travel related stocks on global stock markets are absolutely depressed for obvious reasons. So I think where you can tie the economic fundamentals back to the stocks, I think there's a huge similarity. The market clearly is taking a view that the biggest stocks are untouchable and are risk-free, and I don't think that's necessarily the correct conclusion. I mean, I suspect that the one thing that would worry us amongst people that have high concentrations to all of those stocks is that there will be, the regulators are going to invent all sorts of cases against them, antitrust, anti-competitive behavior, because there's nothing like a business with a huge balance sheet, tons of cash, and governments, needing to fill some budget deficits. I mean, I think there's going to be some comebackings on those businesses down the line as soon as things normalize. So those businesses are not risk-free, and that's what I'd worry about in that case. But in the absence of that happening, the market, those stocks will drive the market further. And below the surface, there are a lot of second and third tier stocks that are competitively disadvantaged that I think, we need to think about owning in our portfolios because those businesses are definitely driving. And one last point I'll just make around the shape of the recovery. I mean, there's a view that I don't think the world we live in, you have an automatic guaranteed reason to grow. I mean, in the old days, if you just had a business, you did things half decently, you would grow. Whereas now you either kill or you are killed. And we're seeing that technology disruption that is at play in many industries working its way through the system, and it's affecting businesses everywhere. I mean, our industry is being disrupted by a number of different players, and we have to get better at what we do. So this idea that we can just sort of sit back and make a few good decisions, I think that doesn't apply anymore. So we have to work harder than ever, and businesses that get that will definitely survive and thrive. And that's quite important to recognize in portfolio compositions as well. And simply to answer your question on the big offshore exposure, we're definitely seeing more businesses that are competitively advantaged from a growth perspective. And that's ultimately what we're interested in. We'd love to own more SA businesses if we could find and understand the growth algorithms a little bit clearer beyond a 6-month time horizon.
Okay, thanks, Clyde. So maybe I'm just going to stay on this offshore theme because I think it is an interesting point of differentiation. So I'm going to ask Duncan the question because I would guess that if we look at the offshore component of the Allan Gray portfolios relative to 91, there's more of a value bias relative to kind of the 91 more growth-oriented bias. And as you were talking, it sort of made me think, if it's kill or be killed, that could mean that sort of invalidates value investing. So Duncan, what breaks the momentum cycle for tech other than the antitrust regulations that Clyde was referring to? And how can there be such differential views if Clyde thinks Nestle is very undervalued, but Orbis doesn't?
Okay, so I think, I mean, Orbis have owned those stocks over long periods, but not anymore. And just to maybe counter Neville slightly, if you look at Japan, who basically, I think the central bank there owns 87% of all TS, their stock market's still lower than it was, at the peak in 1987. Same with Europe. So it's tricky with this thing. Sometimes in Japan, cash was better. But I think if you look at the quality, I think it just really comes down to numbers. I don't think they have any difference on Clyde's analysis, but something like Microsoft's $1 trillion market cap, to grow at 20% return on the share, you need another 200 billion of value to come from. You say, well, how many Microsoft Excels and Office team meetings can I have? It's the same thing for Google and Facebook, and I agree a lot with Clyde. I think if you look at the history of markets, it's always been regulation. But I think especially for the big tech stocks, I think even if Amazon took over almost half the healthcare industry, what's that going to add to the market cap? That's already well over $1 trillion. So, we're something like Tencent, which is still sitting sort of, I hope I don't get it wrong, you guys will know better, somewhere around $600 billion, maybe there's a bit more sort of upside there. And then on the high quality stocks, and I guess it's the analysis when we've asked Orbis a lot, they say they are just not growing the intrinsic value. They would say everyone has this perception, and then if you look through sort of the Nestle, they would say Nestle doesn't grow its sales other than growing sales per share by buying back stock. That people are not willing to pay premiums for brands anymore. Everything's going local. So you have this big headwind, and the way you grow earnings per share is by buying back shares, and your dividend yield's only 2.5. Whereas you can buy BMW and Honda, where significant amount of cash on their balance sheet, great businesses, and if you take out 1 or 2 of them on the sum of the parts, you're getting like 50-60% of the business for free. So I guess it's just a balance, because I must be upfront. Orbis do own NetEase, which has been the biggest share, obviously Tencent's competitor. They do own Alibaba, they do own Samsung, they do own Facebook. So it's not like they're sitting nowhere, but they're analysts around the world to see a lot of value in some of these stocks. And for sure the risk is higher, but they're also shares that can go up quite a lot if you balance it correctly. Okay, great.
Maybe unless Clyde has something to rebut, because you guys seem to be agreeing with each other more than I thought you might, which is probably the first time I've heard that. But unless you have something to rebut, I'm going to move it back to local.
I'm just going to make one point on Nestle, because I think that it's important when you look at a business like that, is that Nestle is competitively advantaged in its space because it over-indexes to two very attractive categories within the consumer space. The one is pet care, which is secularly growing at 5-6% a year. And the other one is the premium end of the coffee spectrum, where through Nespresso, Nestle absolutely dominates. And it's, we estimate that the margins that they make there are in the 90% range. So there's some truly exceptional businesses locked up in there. And what's interesting about Nestle is that as it grows its waters business and its beverage businesses and its pet care business, the mix changes positively. So you generate more top line growth, you have better margins, and you generate better free cash flows, and the virtuous cycle is created on that basis. And I think that is perhaps misunderstood by some people who staring at other metrics. So I just want to make that point on Nestle. In terms of the growth value debate, I mean, what intrigues me is the big value investors always point to this sort of valuation differential. Now, they either talk about price to book relatives that are extremes, or they talk about some sort of value metric on that basis. But any company that you invest in, it's not just about a statistical point in time valuation relative to the assets you own. I mean, a lot of stocks trade well below book value. There are banks that you can buy on 0.2 to 0.3 times book, but you have no idea what that book value is. Not even the risk managers understand the level 3 assets on European balance sheets. And yet some analysts think they can determine what those are. Now the point behind what I'm saying is that if you think about businesses that valuation is one component of it, but the ability of a business to convert profits into cash, to be effective at taking $1 of capital and producing 20 cents of earnings every year and growing that by 10 or 15% is rare. And that is not encapsulated in the single value column at all times. So I take the point that there is a big difference on statistical charts in terms of the valuation spectrum on one metric. But if I were to decompose a typical value portfolio, I mean, I will find our portfolio has a return on invested capital of 25%. The value portfolio sits at 5. Our portfolio is 0 net debt. A typical value portfolio has 4.5 times net debt to EBITDA. Now you could work out for yourself where you think the recovery and the compounding is going to come from on that basis.
Great. I'm going to try and move back to local, because I think that was really where the majority of the questions were. So Neville, I want to ask you, there was a question actually that came through live on the call today, and it was just asking that they felt, it was from Daniel, and he sort of felt that there was a bit of a contradiction in your summary, and he wanted you to elaborate. Sort of on the one hand, you mentioned that you believe that SA equity is going to struggle sort of going forward, but on the other hand, you're reluctant to hold cash, and there's more exposure to riskier assets and growth assets like equity. So maybe you could just elaborate on how you balance that up.
Yeah, so I mean, on the pure SA space, then, if we are concerned, which we are, around the growth in the domestic economy, it's around identifying, as I think Clyde was pointing out, and Duncan to some extent, there are always businesses which either in terms of where they position, they happen to be in a niche of the market that's growing, or there are businesses which are exceptionally well managed and, either through balance sheet strength or ability to deliver high returns, can succeed. So I think, the important point we emphasized is, when we sat in the middle of March, deciding how we were going to allocate capital, was we wanted to make sure we came out of this with the highest quality South African businesses that we could find, because in the midst of March, which seems like a long time ago now, the market sell-off was undiscriminating. Great businesses, poor businesses, they all sold off intensely. So there was an opportunity for us to go and buy what we think are some of the best South African businesses at earnings multiples, which we haven't had that opportunity before. And across the funds, I mean, we were buying things like Shoprite, Spar, Sanlam, for example, which we haven't owned for quite some time. We always felt it was just too expensive, a quality business, but that was too expensive. And, use the opportunity to buy those businesses And so, we have an internal metric where we rank the South African listed shares, high, medium, and low quality. And so today we sit with that rating highest than it's ever been, literally since we started doing that. So, yes, it's going to be a tough economic environment. Yes, there are a lot of companies that are going to struggle. And, this concept of mean reversion is not going to necessarily play out like it did post the GFC. But, there are definitely still opportunities out there to buy great businesses. And, something that hasn't been touched on, but I mean, it affects both the global equities as well as the domestic equity. And it is something that's risky, is again, coming back to this, who's going to pay for all of this? SA actually hasn't, issued the massive amounts of debt that other countries have. Ultimately, there's, this move to the left, there's this concern around inequality, etc. You've got, companies globally sitting on all-time high profit margins. So, if you look at how the pie is split, the returns to capital are at the highest it's ever been. So, one does have to be cautious around, there's some equities out there, I think, where taxes are going to rise. And one has to, these all come into this view of, just being cautious around total asset allocation and which equities one's buying. But from a domestic, maybe just a last point, undoubtedly, you could take an approach of buying a basket, and just, buy a basket of poor quality businesses whose share prices have halved and hope, the one or two double and make it up. But we just, think that that's going to be, identifying those winners out of the poor quality. I think it's going to be very difficult in this environment.
Okay, so maybe I'll ask Duncan. You talked about differentiating kind of the quality from the losers and how you guys categorize SA equities. I guess people would probably put financials in the lower quality bucket. And one of the questions that's come through has been, surely we're going to see some significant write-offs in the banks locally over the next year or two. And how do you balance that risk relative to the positions in the portfolio, or how you view the attractiveness of that sector locally?
Okay, so when I was a bank analyst for like 15 years, unfortunately I had to see Neville during that whole period because he was as well. But I sit there, it was, when are you worried about a bank? When you've had a massive credit boom, right? And we had no credit boom in South Africa, and the dividend yields and the multiples were reasonable. I mean, something like Standard Bank, even though they've made a few mistakes over the last few years, doesn't have a bad track record as a business, nor does FirstRand. And we spent actually 2 whole afternoons where we only looked at the banking sector. So we took the bad debt charges to what does it take to wipe out a year's earnings, what does it take to wipe out excess capital, where do margins have to be, what are the bad debts, moving that all back through. And I think something like Nedbank at 75 Rand was being priced to go bankrupt. I mean, they've paid like a huge dividend just after that. And it's almost trading as a proxy for the listed property sector as an example. So, I mean, for sure, banks are riskier. If you ever want to know about the risks in financials, just sit in on your Africa or Frontier Fund policy groups like I do, right? So Nigerian banks trade on 4 times earnings, even if they make profits. So there's definitely a risk in South Africa that we could go there. But I think our businesses are generally well run. We're not like a German bank or a European bank where your ROE is 5%. So if your bad debts just move a little bit, you make losses. I mean, FirstRand's ROE is like 23. Even if they have 1 year of earning nothing, they can absorb a lot of bad debts. It's tricky because on face value, something like Old Mutual, if you strip out Nedbank, not the best run company in the world as we know, but there's lots of opportunity to fix it. And you're probably paying 6 times what we think it can earn. So I think there's value to be had. But again, that's more a portfolio thing. I think if it was a normal world, we'd have much more in financials. But we've kind of limited ourselves of doing it. I mean, we got offered a big line in Capitec the other day. I mean, as people know, I'm not a massive Capitec fan, but the rest of the team are. And they bought them and it went up 100 Rand a share since you bought it. I would think everyone knows there's going to be bad debt. That's why the share prices are trading where they are. But I'm not worried about the South African banking sector going back. That might be famous last words, I hope not.
Okay, well, so staying on SA, and we said we weren't going to use this opportunity to sling mud at at South Africa. But Clyde, given you've got the lowest SA equity weight, maybe you're a good person to ask about kind of the views and the political risk at the moment. A number of the questions that have come in, sort of hover between, is the SA government going to use this as an opportunity to implement much needed reforms which could help their economy recover? Or alternatively, is this now going to be the start of a new socialist agenda? So maybe we could just get your views on that and how you incorporate that more importantly into the positioning.
Yeah, no, we've had so many false dawns in South Africa on the political front with the hopes of a new paradigm and a new set of policies that'll come out. But I mean, we started this conversation, at 10:30 about SAA needing another 26 billion rand, and yet there's no end to that one. So look, I think the most dangerous thing to do here is to assume that there's a radical change either for the positive or the negative. I think that the very clear way in which government have managed through this crisis gives a lot of insights into how they view their control over the economy, where they want to exert influence, and where they see the priorities. And like I said, I mean, so far I haven't been filled with a huge amount of comfort on that front. Yeah, I mean, I don't need to go through the details of around the ridiculousness of some things that have happened. So our central case scenario on the political front is not to believe in heroism. Now, we know that the world is certainly has. We're not the only country that perhaps have strange people in control. I mean, you've got Bolsonaro in Brazil, who's sort of slightly lunatic in terms of his behavior. I mean, we can talk about the US in particular. I mean, many countries have got political leadership that perhaps is not necessarily respected by everybody, but I think it does sort of reflect the thinking of the median person within those countries, and those people, politicians are not elected without that being the central case, or the central view of people within those population groups as far as democracy survives. So our view is not taking a heroic stance on the politics. I do think that we clearly have to pay quite close attention to the medium-term budget that comes out next week. That's going to be a significant update in terms of where we are around the priorities for spending, and ultimately it's not the numbers. The numbers are not going to be interesting per se, but it's sort of are the numbers credible? Because the numbers have to be bad, and any dressing up of them is going to be quite difficult to deal with. So I think we were looking at the policy markers in terms of what decisions we make on the budget front, because that's ultimately going to be the ones that impact on finance and investments. So those are the things to perhaps watch out for.
Okay, great. Neville, maybe I can take it back to you, and sort of a related question is, what's your view on possible changes to Reg 28 to sort of fund for some of the, the kind of spending obligations that Clyde has referred to? And then a related question is, at what rand exchange rate would you take more money offshore?
Yeah, okay, two difficult questions. The Reg 28, look, I don't, do I expect prescribed assets? No, I'm still, under Cyril Ramaphosa, Tito Mboweni government, I don't expect prescribed assets. Is it important that the savings industry help fund critical infrastructure? Absolutely. It's important around the world. It's somewhere where, where you do see movement towards, funding infrastructure that's important, that's needed. The long-term savings industry can play a role. And I mean, I've sat on many committees for years, for my sins, dealing with government. And, one of the small positives is that this year, for the first time, we've actually seen proper movement from government in order to actually, even just deliver a list of projects that can now be funded. So, I do see signs there where, we can actually move in the right direction, and, enabling or allowing pension funds to have, more investment, just so in terms of freeing Reg 28, so to allow greater investment into infrastructure assets, that's a good thing to do. Pension funds, you're hedging long-term liabilities. A long-term asset which delivers inflation plus earnings growth is a fantastic asset to own, but it needs to be managed properly, and you need to make sure there's rule of law, and needs to make sure that you can collect whatever fees, and that's where often we fall down, and we've yet to see any meaningful changes there. I mean, the fact that the toll roads in Gauteng are still not paid for, is a massive flaw in that argument. So I don't see malicious intent or anywhere under the current ANC government to kind of force assets. I do see steps, I think, to try and encourage and crowd assets in terms of making the investment more attractive. On the currency, in the short term, I definitely, it depends on what the outlook is. So, and depends, are you trying to trade the currency, or, are you doing a long-term asset allocation? We do think, so I mean, asset allocation, I mentioned earlier, we did think that global equities are going to generally perform better because they've been supported better. So, if you're taking money off to invest into asset class, yes. But, we think the rand can strengthen easily into the low 16s or even tighter from here. And, some of the points that Clyde made about resource, South Africa, we completely stuffed it up at the beginning when we shut the mines down, sent everyone home to get the coronavirus. Now they've come back to the mines with it. It would have been a lot better if they just left them there. And, but we are still, a big exporter. The rand, as I said earlier, did weaken significantly. So the mining sector will, be making significant gains. The agricultural side is doing exceptionally well. And with the rand having sort of done what's done, with the economy having been closed, imports, will have fallen off a cliff as well. So our terms of trade are actually significantly better than they've ever been for some time. So, we do actually see the rand strengthening into the next 6 to 12 months. And if you're on a short-term trade, I'd wait for it to get to 16 or stronger before taking money off.
Okay, great. Thanks. So you probably would have seen that we just asked a very quick poll to extend the webinar by a couple of minutes. I want to ask one or two more questions of the panelists, and then I'm going to allow them to wrap up. So we will aim to end at 11:40 at the latest. What I wanted to do was just sort of follow on from Neville's comments on resources. And I'm going to sort of take it back to Duncan. So I think we've probably got not dissimilar views of three firms on resources recovering, but we've got quite different positioning. So Duncan, maybe you can talk to Allan Gray's weighting in Glencore and Sasol relative to Cora's biggest position is, I think, Anglo's, and Clyde's is BHP.
Yeah, so the two words I hate most in life are iron ore. So we've just been completely wrong on iron ore. As the people who are listening would know, I've been bearish on China infrastructure for forever. BHP pulls something out the ground for $10 and sells it at 100. I mean, it's a resource that's abundant around the earth. So we do have a smaller position in BHP. I mean, I think it's a top 15 share, but I guess the feeling here was the discount put on Glencore because of the Department of Justice investigation is massive. It's like almost in the double billions it's close to like $10 billion on our view. And wherever, I mean, these resource companies, as Clyde and Neville, are very hard to pick, but our upside on Glencore is close to 60-70%, where we don't see the same on Anglo's and BHP, but it's mainly a normalization of the iron ore price. And Glencore, of course, has the marketing business, which makes about $2 billion EBITDA, and their biggest competitor reported their first quarter results, whatever, I always get it wrong. Their profits from oil trading were up 80%, and Glencore is the biggest trader in oil. So we think they could also have a massive few months there. So Glencore is typical of a stock where if a few things change, I think that there could be some upside. Anglo's is a hard one. We don't have a strong feeling either way. Again, it comes down, Neville can correct me, but I think Kumba and Amplats is probably 64% of the share price now. So if you back that out, you're paying very little for the rest of Anglo's assets. I mean, Sasol is, it's probably our biggest mistake of the last decade. We hope you only have one of those every decade. As people know, though, the one positive was we did sell about 40% of the position. And what we've explained before, when the sort of second cost overrun came, we reduced Sasol's risk rating, which means we didn't buy on the way down, which was a good thing. I'm talking more from the 450 to the sort of 200. We didn't buy hardly any shares on the way down. I mean, now, I think it's up like, 7 times from the bottom, and it's just trading as an option now, the equity. I mean, the debt's 190 billion. The market cap must be close to 100 again. So any recovery in those low-density polyethylene prices or oil, and I saw this morning the banks waived their covenants for the next year. I mean, if they come out of this without a rights issue, and it could double again, but it's a risky share, and Neville always points out their poor management, it's there, but we'll see how it goes from here. But yeah, sort of the way we're thinking about it is, whatever your position is in Sasol, in reality it's bigger because the transfer rights offer is probably 75%. So if you have 1% in it, well, you actually have a much bigger position because you know you're going to have to fund the rights issue. So at the moment, we kind of just sort of probably trimming a little bit just to make room in case there is a rights issue. But we apologize to everyone for Sasol.
Okay.
It's not Microsoft.
Okay.
So if you can jump in, Tamara, just, I mean, interestingly, I mean, resources, I mean, we do have quite a big weighting to resources. We have had for some time, we've added during this section, is if you look everywhere around the world, what is everyone kind of touting as their solution to getting economies going again? It is infrastructure-led spending. So whether you're looking at China, you're looking at Donald Trump, trying to, again, rolling out his $1 trillion infrastructure plan he hasn't done for the last 4 years. Europe talking about it, South Africa. So all of that net is bullish for various commodities. It's not just iron ore. A lot of people talking about, they want to come out of this with a bigger bias towards clean energy, things like copper, etc. So, there is a very strong story for the next few years that, some of the stimulus is going to come out of equity markets and punting stocks and actually start going into infrastructure, which is bullish. And something like in Anglo's, where we are largest, we believe in the value of diversity. There was a stage where, companies like BHP, for example, were selling off all the peripheral commodities and just focusing on one or two. We think a broad, diversified basket does add value when one commodity is troughing, another's peaking. And we think it's probably the most diversified of the diversified miners now. And that's something that we don't think is reflected in the rating.
That's great. And actually, sort of as I was listening to you, it sort of half answered a question that's come in, which is which sectors do we think will actually benefit kind of coming out of this period? And obviously, you've spoken to infrastructure as one. Clyde, maybe I can ask you, what will we look back on in a year or two's time and comment on a significant change in maybe consumer behavior or patterns and sort of say, okay, well, that sector was obviously primed to position, to benefit from that change in behavior?
Yeah, look, I mean, we're very loath to make big forecasts about change behavior during a time of a crisis, because I recall with great fondness how many people within our business said in 2009 that nobody would ever buy a luxury watch again because luxury goods sales would be dead forever. And I mean, you can just see the next 10 years was one of the most robust periods for luxury goods, and obviously watch sales took off dramatically. So we're very sensitive to the fact that a lot has been spoken about structural changes in consumer behavior. And obviously, industries that will be permanently impaired through that. I mean, I think the one thing that I would be prepared to put a forecast on is that travel stocks will probably do better, particularly better positioned businesses that can survive. The online travel agents in the world, I think, will do quite well from current levels. When you look back 3 years, and it's not going to be a 1 year story, it's going to be a 3 to 5 year story on that recovery trail. But I mean, the pent up appetite for people to go on holiday, to travel is not going to be permanently squashed. due to COVID. I mean, I think that's one thing that I'm prepared to I'm prepared to bet on. In terms of marginal changes, I think the one thing I would certainly hope for is that health and hygiene standards are much better going forward. Whereas we know that many countries around the world can do a lot better on that front, and I'm certainly hoping that will be a permanent change behavior. I'm seeing more hands being washed in our household than ever before, particularly from the younger hands. So I think that hopefully would be a positive spin-off. But in terms of behavioral changes, very few to offer. The one thing that has again become quite clear is the difference in divergent performances between businesses that have a proper online offering. And I'm not talking about some dingy little website that's got no eyeballs, which is unattractive. I'm talking about a proper integrated, click right through to delivery offering, and the importance of that to be relevant in the world. And just to give you one quick example, I'm not going to monopolize the conversation here, but the difference between Nike and Adidas in terms of athleisure is stark. Nike has been spending 10 years refining their online, their direct-to-consumer model, and you can see that in terms of the behavior. When COVID hit, Nike's traded throughout. 35% of their business has moved online. Adidas sported an online offering, but it grew its online massively in April and May and June. But it still required 3 billion from the government in Germany, and it needed a bailout in order to fund the repurchase of the stock on its traditional bricks and mortar channels. So the point behind the story is that is hopefully a wake-up call for businesses to think more carefully about how they distribute, and I think that is something that South Africa is perhaps woefully behind the curve on, that we need to up our game, I think, if we want to remain relevant going forward.
Okay, great, thanks. All right, now I did promise that we would end at 11:40, so I'm going to allow every presenter only a minute, please, just to quickly wrap up with some key points, but I'm going to stop you after a minute. So Duncan, can I start with you? And I won't pull up any slides, you can always send them after the presentation.
Yeah. So my own view, personally, it's not everyone here, markets have run ahead of themselves, particularly the US. I think positioning is pretty extreme. If there's one thing that's going to surprise, and I'm sure it would be everyone listening here today, is that local domestic equities do better than people think. I mean, no one's pricing that in. I don't know if that's going to happen. And I echo what Neville said similarly. Given these kind of valuations before, especially on local assets and bonds, you'd be disappointed if balance funds don't do better than they have the last few years. Like, we know the long-term good balance funds have beaten CPI plus 5 over very long periods, and they haven't over the last while. And I'd be disappointed if they can't from this price levels.
Okay, great. Clyde, maybe keep it the same order as we started off with. Do you want to go next?
Yeah, I would venture to say that offshore will continue to outperform onshore. So I would disagree with Duncan's assessment on that front, and I'm very happy to put that down over any time frame, perhaps other than a 2-month or a 3-month view where anything can happen in that recovery trail. So we're confident in the positioning. I don't think that markets are ahead of themselves. I think this has been one of those hated bull markets that most people have been poorly positioned for in the recovery, and everyone's waiting for a second bite at the cherry. So I think the path of least resistance is probably as unfashionable as what it is up. So we're more confident on that front, and I think the balance of your portfolios should reflect where you have the highest confidence with the lowest levels of risk at achieving decent returns, and that's how we've sort of structured our portfolios with the positions we've taken.
I'm leaning more towards Duncan here, and that I do think there's, we do think developed markets have run ahead of themselves, and the world is fraught with risk ahead of us, and we haven't even spoken about the elections coming up and how the market's going to stomach a democratic president coming. So certainly we see there's many reasons why this kind of relief liquidity rally can peter out quite quickly. But leaning somewhere back towards Clyde, though, rather than buying some of the lower quality domestic SA businesses, we do think SA government bonds, towards the back end of the curve with 11+% return are attractive, and we have upped our weighting there. And so when you look at the building blocks, with, domestic equity, with the quality names, we're thinking, achieving 30+% upside, with bonds with 11% returns. We do think multi-asset portfolios do have very attractive returns in terms of all the building blocks that we can use.
Okay, great. So it just remains then for me to wrap up and just quickly to say again, on behalf of all three of us, just thank you very much for taking the time to dial in and to listen to us. And I hope it was useful, particularly in understanding the sort of the differences in view across some of the core asset classes today.